Start now.
All right, we're gonna go ahead and get started. Welcome everybody. Thank you for being here this morning. For those of you that are on Zoom with us, and for those of you in person with us today, my name is Alex Pinacho with Vista Prime Loans. I'm the loan officer that sits right here in the Miami Lakes office. You can come visit me whenever you want. Today we're gonna talk a little bit about loan options that we offer for investors. If you guys have any questions, I'll try to monitor the chat. So if you have any questions, you can pop it in the chat or just unmute yourselves and I'm happy to answer. And if there's any questions that are asked here in person, I will let you all know what the question is. My contact information is right on this first page of the screen and you'll see it on every other slide. There's a QR code on the bottom left that you can scan and download my contact information. And on the bottom right, you have my Instagram and Facebook contact, my email, my website, and my phone number. That'll be on every page. So if you don't miss it, if you miss it, don't worry. We can you can see it on the next slide. All right. So just want to give you guys a little bit of about me. I'm married. I have 3 kids. The picture on the right is a picture of me and my wife on our most recent trip to North Carolina at a waterfall. And the one on the left is my 3 kids, Tatiana, Zare, and Shant. Tatiana's 5 years old, Zare is 3 years old, and Shant is 1 year old. So, yep, that's my girl and my 2 boys. And this is the reason why I do what I do. This is the reason for me working. Hi, Melody. So a little bit about Vista Prime. You guys already knew who we were before when we were with CMG. Vista Prime is a company that we opened up. Our group opened it up independently. So now we have the option of brokering to over 20 different lenders that we're currently registered with. But it also affords us the opportunity to be more competitive on pricing. It allows us to add lenders as we need them. So if you ever encounter a lender that's doing something that we don't currently do or we don't currently offer, we can go ahead and register with them. So Vista Prime Loans is registered and licensed in Florida. We have additional licenses currently pending in North Carolina, Georgia, Texas, and a few others. Our team consists of 20 employees, give or take 1 or 2. And this includes our whole team of loan officers. We have 3 processors that are that work with us directly, and we have an operations team. And the experience of the team includes, banking experience, real estate, mortgage, and appraisers. So we have a whole team that really understands the financial process and the real estate process. We've been doing this for many years. Some of us have been doing it for as little as 3 years. Most of us have been in the industry in some way, shape, or form for at least 10 years. This is great because whenever we have an issue with a transaction, whether it be an appraisal, something insurance related or anything else, we can take it up to our operations team and work in a way that we can figure it out. Something I didn't include here is that we are a 95% purchase shop. What that means is that 95% of our business is purchase transactions. We're not a group that does a whole lot of refinances. We can do them and we like to do them for past clients, but really we focus on helping you guys grow your business by being a support for you as realtors and making sure that your clients get their transaction closed in a timely manner. And additionally, making sure that when you provide a pre-approval letter to the listing agent on behalf of your borrower or your buyer, you're sure that pre-approval is a solid pre-approval. Okay, so that's one thing that we take pride in reviewing pre-approvals to make sure that they are accurate and that your borrower is indeed approved once the transaction comes through. Okay. This presentation is loans for investors. Good morning. The presentation, just kind of little compliance here. The presentation is for information purposes only and is not meant to be used for underwriting or qualifying of a buyer or borrower. If you or your clients have questions regarding a specific client or loan scenario, please consult with a licensed mortgage loan originator. This presentation is solely to inform you of what types of options are available to buyers so that they are aware that options exist outside of traditional loans. So again, very important. If you guys have a client that is looking for a property and is not sure whether they would approve or not, I'm more than happy to speak with them. I'm more than happy to review their financial situation and offer whatever solutions we can, whether it's a traditional loan or whether it's something else that we're going to review today. I wanted to, before we got started on the actual presentation, I wanted to give you all some important terms and acronyms that you're going to see throughout the presentation. Some of them you may be familiar with them. Some of them are pretty new or maybe new to you. So I'm just going to go down the list. DTI is the debt to income ratio. And all that means is that we're going to qualify them based on how much money they make. They cannot surpass a certain amount of that money. So typically that's about 50% of their income. Their debt cannot exceed about 50% of their income. Some loan scenarios are tighter than that and some are a little bit looser. Loan to value, simply put, is the amount of the loan versus the purchase price or the appraised value, whichever is lower. DSCR, this is an important one. Good morning. DSCR, we're going to cover this in more information later, but it's debt service coverage ratio, and it's one of the loans that we offer. It's a type of loan that we offer for investors. ARM is an adjustable rate mortgage. So contrast to a fixed rate mortgage, we'll go into that as well. ARV means after repair value, and non-QM means not a qualified mortgage. Good morning to those of you that just arrived. We're just getting into the presentation, so this is you just missed some information about who we are and what I do, but we're getting into the presentation now. So the categories of investment options. There's a lot of information on this, and as you guys go through the presentation, if you are taking notes or if you have some questions that you want to ask me, let me know. But basically, we have three main categories for investment options. We have conventional financing loans. Those are your traditional Fannie, Freddie portfolio loans. You have your non-QM loans, like I just mentioned, they're not qualified mortgages. And those are the types of loans that are DSCR loans, bank statement loans, fix and flip loans, bridge loans, and multifamily loans, anything above 5 units. And then we have loans from private lenders. Private lenders can offer some of the loans that are in the second category as well, but they usually are being offered because they're a higher risk. Maybe the credit score is not there. Maybe the value is a little tighter. So there's a number of reasons why they would be able to offer those loans and why we would go with a private investor. And we're going to get into all of this. So I'm going to start off with the conventional. The conventional is the most traditional type of mortgage. And it's for your traditional borrowers. So it's for your borrowers or investors that have documented income. Maybe they're a W-2 employee or they have a business that they run and they can show 2 years worth of self-employment or employment income documented via tax return. We are going to qualify those borrowers the same as we will qualify them for a primary home purchase. And we would use the additional rent from the investment property. Okay, so this is a program for investors today. So everything we're talking about is just investment loans. So with these types of loans, if an investor is already at that 50% debt to income and they're buying a property and that property is going to have rental income, we can absolutely use that rental income to help them qualify for this loan. Okay. The good things about conventional loans is that they typically have a lower down payment option. So a minimum of 20% if it's a single family. If it's a multifamily, it goes up to 25 or 30%. Same thing with a condo. Typically, you have lower interest rates because it is a conventional product. These products, you can get them either in a fixed rate or an adjustable rate mortgage. And most of the time, they come with a 30-year amortization. And as I mentioned, the subject property rental income is included in most cases. And this is restricted to 1 to 4 unit properties. So your condos, your townhouses, your single family homes, and your multifamilies up to 4 units. All right, this is what we do for a conventional loan on an investment side. Now, again, Very important. This is for the borrower that is already employed, has been employed for 2 years, shows a solid income, has great credit or good credit, low debt, and we're going to use the rental income. The biggest difference between this loan and the other loans that we're going to look at is that when we talk about the rental income on these types of loans, we're using only 75% of the actual rental income of that property. And that 75% of the rental income is based on either an existing lease that's in place or an appraisal with a 1007 attached, which is the rental income appraisal, that section of the appraisal. And that's a separate component to the appraisal that does not come automatically included. Usually costs about $200 more to get that done. Okay. We're going to use the lower of the two values on a conventional loan. So if the appraiser says this property can rent for $3,000 a month, but the existing lease in place is $2,000 a month, we're going to use the $2,000 a month. We're not going to use the $3,000 a month. Okay. And of that $2,000, we're only going to use 75%. So we're really going to credit them for $1,500 a month. Okay. Because it's conventional, it goes to Fannie Mae or Freddie Mac, or maybe the bank keeps it in the portfolio. Guidelines are much stricter on these loans. All right. The next type of loan is what we call the non-QM loans. And non-QMs are what we see in our industry that most investors are using to purchase properties. There's a number of reasons for them. Most investors don't have traditional income. Maybe they do have a full-time job. Maybe they do have a self-employed job, but a lot of times they're writing off a lot of expenses on their real estates, on their businesses. They're basically doing everything they can to reduce their tax liability. So because of that, they typically don't qualify for a conventional mortgage. Okay. So this is where the non-QM products come in. Now I'm going to go back 2 slides here. Because I want to show you again, line 2, the non-QM products. We have the DSCR, bank statement, fix and flip, bridge, and multifamily. I'm going to touch each one of those real quick so that you guys know what they are. DSCR is when we do a loan that's simply based on the rental income of the property and the monthly expense of that property. Okay. So it's a debt service coverage ratio. Bank statement loan is for, like I said, that self-employed borrower that is looking to purchase a property and really doesn't have traditional income, but his bank statements show a lot of income, and the tax returns just show a lot of expenses. Fix and flip loans, pretty self-explanatory. It's for your investor that is going to buy a property, is going to repair it, rehab it, and flip it. Bridge loan is for borrowers that maybe don't have enough money to buy their next property, but have a lot of equity in their current property. So instead of doing a refinance and then buying the next property or whatnot, we do a bridge loan for that property, on the first property, so that they could buy the second property. Okay. And then the last one, when I say multifamily in this scenario, I'm talking about 5+ units. So if you have a buyer that's looking to buy 5 to 8 units, or is looking to buy a 10, 20 unit multifamily building, we have options for that as well. Okay. So I'm going to skip again to that non-QM slide. So like I said, this is for investors without traditional income, or maybe they do have traditional income, but they have a lot of expenses, so they can't justify their income. Down payment options on these, we do have some lenders that'll go down to 15% on these types of loans, especially on the debt service loans. So it's a good option for somebody who wants to buy a property, maybe has a lower down payment and doesn't have a lot of income to present. If their credit score is good enough, we can go up to 15% down. Interest rates on these, we got moderate interest rates on these, okay? I like to say A paper, B paper, C paper. So conventional products are what we call A paper loans. These are what we call B paper loans. So these rates are typically going to be a little bit higher than what conventional rates are, okay? Because again, there's not as much underwriting that happens on these types of loans. With these loans, we can also get a fixed rate or an adjustable rate mortgage, and we can get a 30 to 40 year amortization. So that's nice because if we have an investor that they want to get the first 10 years, they want to do interest only, and then they want to have a 30-year repayment, we can get them a 40-year loan on these. Okay, so that's a pretty cool thing to talk about. And then the subject property rental income is included in most cases to qualify. So the ones where it's not really used to qualify are that fix and flip loan, the bridge loans. We don't really use any income on those types of products. We just go based on loan to value and make sure that it makes sense. But other than that, you're typically using that rental income as well to make sure to qualify that borrower. And when I say borrower, guys, I mean borrower / buyer. So obviously there's a buyer, there's a borrower, and vice versa. So I get the terms confused every once in a while. Okay. So these products, again, I am going to go into a little bit more detail on the non-QM and on the debt service and on the fix and flip loans. But I wanted to kind of give you the overview on these particular loans just off the top. I personally use these loans a lot. I've used them myself as an investor, and I've used them for a lot of existing clients. The nice thing about when we're talking about non-QM loans is that when you have a conventional loan, most conventional loans mean that your borrower cannot exceed more than 10 loans. Once they have more than 10 properties with 10 loans on them, they cannot go conventional. No matter if they are super qualified, Fannie Mae and Freddie Mac do not allow it. With non-QM loans, there's no restrictions. Some lenders have restrictions where they won't give a borrower more than 10 loans, but that doesn't mean they can't go to another lender and get another 10 loans and so on and so forth. Okay. So we have a lot of options when it comes to how we can expand on these programs. If you have a buyer that is really looking to grow a portfolio over the next 5-10 years, these are definitely the types of loans that we're going to be looking at for them as the time goes on. They're easy to qualify. There is no DU approval on these types of loans. So if we're putting in an offer on a property and the listing agent is asking you for a DU approval on these types of loans, that's not going to happen. They're not going to get one. We're going to give them a pre-approval letter. It's going to state on there that it is a portfolio loan. We're never going to say it's a non-QM loan. We're never going to say it's a debt service loan. The listing agent doesn't need to know exactly what type of loan it is. We're just going to let them know that it is a portfolio loan. Okay. And that is what it is because mostly these lenders will keep it in their portfolio. So the third category that we've talked about is private money. Private money is for investors without traditional income. These down payments are usually a lot higher. So they minimum of 25% down. The interest rates on these are much higher because you're actually borrowing private individuals' money. Okay. The terms on these loans are usually only 1 year and sometimes 2 years, depending on the borrower, depending on their experience, depending on the project. There's a lot of factors that go into this. Yeah. Yeah. It's a very short-term product. Yes. Yep. This is for, these types of loans are for, somebody needs to get into a property quick. Okay. They need to get the financing right away. They don't have time to wait for an appraisal. They don't have time to wait for condo docs. They don't have time to wait for, basically like I got 10, 15 days to close on this loan. It's an investment property. And then I got to figure out the financing later on. Okay. This also works a lot for when you're looking at a building that maybe is not in a habitable state. So instead of going with a fix and flip lender, maybe you're somebody that's going to do all the work yourself. Maybe you don't have a general contractor that's going to do the work. Maybe you have a lot of experience. You don't want to go through the bank giving you a set of guidelines. So in other words, this is for the person that's like, you know what? Time is money. I want to be able to move on this. I want to be able to move quickly, and I need to get funded quickly. I can't wait for the bank to send an inspector and come back and do all of this kind of stuff. Okay.
Like a hard money lender.
Hard money lender, private money, hard money. Those are all the same interchangeable terms. Yeah. And these terms, these loans typically are based on the loan to value of the property, the ARV, which is the after repair value of the property, and the exit strategy. Okay. Now, what do I mean by exit strategy? When these lenders are lending their money, they want to know what your plan is for this property. They're not going to give you this money for you to just, keep trying to renew it with them. That's not what they do. They do very, very, very short-term money. So they want to know that when you're buying this property, You're going to fix it. You're going to flip it. You're going to refinance it in a year. You're going to sell it. What's the exit strategy? What's the plan? Obviously, that plan can change, but they're not going to lend to you if you say, I don't know. Okay, you have to know what your exit strategy is. Okay. And a lot of times what we do is, if we have a client that gets a hard money loan or a private money loan, we're already talking to them within 6 months of, okay, so you've repaired the property, you have it rented out. What's the game plan? Are we going to refinance it or are you going to sell it? So you as realtors, if you have these clients, this is great, because if those clients are going to fix and flip, guess what? They're going to need the person to represent them to flip. Okay. So you guys can get on top of that. When the property is ready to sell, you can start advertising, marketing it, and then you guys can get that end transaction as well. On our side, if the client's going to keep that property, then we're getting them prepared to do a refinance. Okay. Another time that this is used a lot is when we talk about multifamilies. When you talk about multifamily lending, there's a couple important terms that are involved, and one of them has to do with the occupancy of the building. Most times a traditional lender will not finance that project unless it's at least 90% occupied and it's been stabilized for a period of time. So it's been rented for 90 days, 90% occupied, that kind of stuff. So a lot of times when a buyer wants to buy a distressed property, or maybe a property that is just not stabilized, maybe it only has 40 or 50% occupancy, maybe it hasn't been renovated in 50 years or whatever, that's where we would probably go to a hard money lender instead of going with a non-QM lender. Okay. And I put at the bottom, bridge loan and fix and flip are 1 year only. That was from the previous slide, but just keep that in mind. And in the private money, like I said, it's typically for 1 year. And at times we can get an extension on it for a second year. Okay. But again, private money guys, they have a responsibility to their investors. And that's their primary responsibility to their investors. So their thought process is, we're going to give you this loan. We're going to do it for 1 year. You have to have investment experience. Private money guys are not just going to lend to anybody. If there's a first-time investor, they're going to want that first-time investor to work with a sponsor. So somebody that has already done fix and flips before and can guide them through their first and second flip. Okay.
And if they take out a fix and flip loan already, would that have been an experience for a private lender? An experience for a private lender is
it doesn't have to be a transaction involving money. It has to be that they've owned a property, an investment property in the past. Now there's obviously different points of entry. If I owned a condo unit before, and that's all I owned, and I just had it as a rental, and now I'm asking for a fix and flip loan, that's a totally different animal. Okay. So the fix and flip, they may still require that you partner up with a sponsor. Okay. And I want you guys to think sponsor as when you first got your license, you have Joel here in the office that's helping you guys and coaching you guys. And what you guys are doing is you're paying him a percentage of your cut. So it's the same thing with a sponsor when you're doing a fix and flip deal. You're paying that sponsor a percentage of your cut, and they're there to help guide you and make sure that you don't lose money, or that you lose as little money as possible if you do lose money. Okay. So they're there to tell you, hey, you don't need this $5,000 refrigerator. You can get a $1,000 refrigerator. You don't need this, Versace tile. You can get nice plain tile and just make it look nice and spend a lot less money. That's what they're there for. Okay. The biggest point that I need to mention in these last two slides for non-QM loans and private money loans, when you're talking about loans for investors, most lenders are going to require that the individual owns their primary home. Okay. They do not want to lend money to somebody that does not own their primary home and can later move into this house and start using it as their primary home. That's not what they want. Okay. So keep that in mind. If you have a client that says, well, I want to buy an investment property, but I'm still living, in my parents' house. Again, we can do it, but we have to do it as a conventional loan. Yep. There's very, very, very rarely the time that a non-QM or a private money guy is gonna, or company is gonna lend them money on these, okay? All right. DSCR calculation. Excuse me one moment. Okay, DSCR calculation. Like I said, this is probably one of the easiest loans that we do. And it's a pretty cool product. I particularly, like I said, I personally have used them in the past for myself, for friends, and for other investors. The way the loan works and the way the loan is qualified is very simple. We're going to take the principal, interest, taxes, insurance, and association, so PITIA, that is the housing cost. We're going to take the rental income and we're going to divide it by the housing cost. Very simple math. If the rental income is $3,000 a month and the housing cost is $3,000 a month, you get 1x, 1.00x. If the rental income is $4,000 a month and the PITIA is $3,000 a month, then you get 1.33x. Okay. If the rental income is $1,500 a month and the PITIA is $2,000 a month, then you get 0.75x. So why am I using those specific numbers? Most lenders require a minimum of 1x in order to finance a transaction. There are some lenders that if the credit is strong enough and they're coming in with a significant enough down payment, will allow for a 0.75x, which is that third scenario I gave you. So the rental income is less than the PITIA. And there are some more lenders that allow for a no ratio loan. Okay. Now a no ratio loan basically means we don't care what this property is renting out for. We're going to go ahead and give you the loan. Now, what's the catch? Number one, the interest rate is going to be much higher. Okay. Number two, you have to be putting in a significant down payment. Number three, you have to have great credit. And number four, you have to have investment experience. If any one of those four don't hit, you're not getting a no ratio loan. It's too risky for a bank. Okay. Now, what are some scenarios that you might see where a no ratio or a 0.75x might be a factor? I'll give you one great example. Some of you already know that I bought a cabin in North Carolina. The cabin in North Carolina, if I were to try to rent that out as a regular monthly rental, is going to rent for about $2,500 to $3,000 a month. Okay. The mortgage on that property is $4,000 a month. What's the purpose of that property? It's to be rented as a short-term rental. Okay. As a short-term rental, it can generate anywhere from $6,000 to $8,000 a month. But a lot of lenders won't use short-term rental income to calculate the debt service coverage. Okay. Why? Great question. The question is why? And the reason is twofold. Number one, short-term rental is pretty new when you think about how long these loans have been out and how long appraisers have been doing business and how long rental income has been factored. Short-term rental income has really only been around for mortgage purposes for about 3 years. Prior to that, that wasn't even an option. Nobody even knew about that, okay? So because of that, unfortunately, you have number two, which is that appraisers go out and they don't understand what a short-term rental looks like, how to calculate it. There's just not enough data. Think about when you go on Airbnb or VRBO to look for a property, you don't know the property address. You're just looking at the pictures that are online and the amount that it's renting for and the description that the host puts up. You don't know where the exact location of the property is, so you can't find a property address, right? So that makes it very difficult for an appraiser to do their job, okay? So the lenders that are doing this are saying, hey, you know what, we'll take that income, but we're not going to do it at 15% down. We're not going to do it with a 720 or 700 credit score. We're going to do that for a 740 credit score. You got to put 25% down. There has to be a lot of factors in that for them to consider. We got to prove that income. So if we can prove the income.
Oh, I mean, the host is didn't pay a certain amount, then you still use it as food.
That's a situation that will be like case by case, where some investors may look at it and accept it. The problem is, and I'm gonna speak to you as a host myself. What I do as a host and what you do as a host could completely change that property. I might be getting only $5,000 a month, and you might do something that now you're getting $10,000 a month for it. Vice versa, I might be getting $10,000 a month. I sell it to you, and now you're only getting $3,000 a month. Maybe you're not marketing a property. Maybe your reviews aren't great. Maybe so. A lot of factors go into that. Okay, so it's still it's possible, but it's still a situation where a lot of times we end up going to that lower ratio loan, and we just say, okay, fine, what is it going to rent out for traditionally? And then we'll use that factor. And that's where the 75X or the no ratio comes in. Okay. Great question. And honestly, it's challenging because I'm working on one of these loans right now. I have a buyer that's buying in the Keys, and it's a similar situation. And the appraiser originally came back and said, well, the rental income is $3,200 a month, and we need it to be $6,800 a month. And we came back and we said, no, you're using the wrong type of income. You're using monthly. We need short-term, we need daily. And he did another thing and came back and said, well, the short-term rental, I'm judging it to be $5,500 a month. And that's still not where we need to be, okay? But again, this borrower has great credit. They're coming in with a pretty good down payment. They have experience as an Airbnb host, especially the fact that they not only have experience as an Airbnb host, they have experience in the Keys as an Airbnb host, because that's also different. I may have a lot of properties in Fort Lauderdale, but not know the North Carolina market, okay? So that's another factor that they look at. So in this particular case, we're going to be able to push the loan through, even though we're not at the number we need to be at, because the income is strong enough, the experience is strong enough, the credit is strong enough, and the down payment is strong enough, okay? Changing gears a little bit, fix and flip loans. Fix and flip loans, on the non-QM side, so option B, this is for your borrower that, again, has some experience. Maybe they've done a couple of rehabs already. They've owned investment properties in the past. This one we can get away with if somebody has not owned a property in the past, an investment property. We can get away with it with a higher interest rate. But it's just, again, it's just another challenge we have to overcome, right? But we can certainly look at it. Now, on this one, the minimum down payment is 20% on the purchase price. So you're buying a property for $200,000, you got to put 20% down. So that's $40,000 you're putting down. The rehab is going to cost you, 80 grand. We'll give you 100% of that rehab budget, but it cannot exceed 70% of the after repair value. So if we're giving you $160,000 up front and then another $80,000, that's $240,000. That property has to appraise for, I don't know what the math is off the top of my head, but about $315,000 or more. Okay. If it doesn't, we're not going to give you the 100% rehab. We're going to cut it back based on the ARV. Okay. The rehab are draws and they're done as reimbursements. So this loan is a little bit more in depth when it comes to underwriting, because we take the purchase price and the appraisal, and we use, in order to get the appraisal done properly, we actually use an estimate of what you're going to be doing to the property. Okay. So you are presenting at the time of application the purchase contract, and you're presenting the budget, and you're saying in the budget what it is that you're planning to do. Okay. Typically, you want to have a quote from a GC, just so that we can really be looking at accurate numbers and we know what we're looking at. Now, the appraiser is going to take, the construction team is going to take that information and make sure it makes sense. If you're budgeting $30,000 for a roof, they're going to look at it and say, yep, this $30,000 seems accurate. If you're budgeting $100,000 for a roof and it's a 1-1 in Margate, they're going to say $100,000 doesn't make sense for this roof. Okay. Once they have that settled, they're going to send that information over to the appraiser. The appraiser is going to give two numbers. He's going to say the property today is worth this much, which we're hoping is at least the $200,000 that you're buying it for. And based on these repairs that are going to be done, the property should appraise for $350,000, let's say. Okay. So you have a nice number in there. Once that loan is approved, again, you're gonna pay the $40,000 down. You're gonna get a loan for 160 and a draw loan for 80. It's a line of credit. It's typically good for a year. Okay. And what you're gonna do is you're gonna start the work. And as you complete the work, you're gonna go to the lender and say, okay, I just redid the roof. It was $30,000. Can I get a reimbursement? So they're gonna reimburse you for the jobs that you're doing as you go doing them. Okay.
Wait, this for fix and flip?
This is for fix and flips, correct? So you're putting in your 20% down at closing, and then you're putting in the first piece of the project. So you're gonna get the project started and you're gonna get reimbursed. Okay.
So, oh, but sometimes it's different when you do fix and flip, like you could put as well as 10% down, or this is just for this type of fix and flip loan?
This is for fix and flip loans in general. There's very few lenders that do 10% down. I'm not saying it doesn't exist.
Because I'm.
Yeah.
$100.
Yeah,
So, but for example, 20% down of the purchase price.
of the purchase price, right?
Then,
And then 100% of the rehab budget.
oh,
Okay.
I have to pay that, if I'm a fix and flip, I have to pay that?
No. We'll finance 100% of the rehab budget. Yeah. I'm sorry.
And
That might be a little confusing. Yeah. So so the investor has to put 20% down of the purchase price. And then we will finance as high as 100% of the rehab budget. So if you guys are following me on Zoom, that's a clarification I want to make. That you can do 20% down and we will finance up to 100% of the rehab budget. Okay, that's very I'm sorry, that does look a little confusing now that I'm looking at it on the screen.
I understand when you said it.
Now, the total combined loan amount between the two cannot exceed 70% of the after repair value. Okay. Keep the questions coming.
Y el crédito más o menos que tiene que tener ahí.
Para el Oh, okay, you speak Spanish.
I'm sorry.
No, it's fine.
No, I heard both of you, but I'm gonna answer one at a time. So the one question I got was, what's the minimum credit score? There isn't necessarily a minimum credit score depending on the lender. But you also don't want to have, bad credit or collections, foreclosures, bankruptcies, because then it gets a little bit, then we might have to go private money. Okay. In these cases, they look a lot more at experience. So if you have somebody who has really bad credit, but they've already fixed and flipped, 5+ units, they're more okay with that than somebody that doesn't have. But the credit is going to determine the pricing.
Wait,
Okay.
pricing of how much,
The rate.
but if it's a fix and flip, it's not really gonna be for you, right? It's gonna be for, you just trying to sell it.
Yeah, but it's fix and flip is you're buying it, you're going to rehab it, and then you're going to sell it. But the rate that you're going to get during that process, so let's say it takes you 12 months to rehab the property. It could, yeah. Depends on how complicated the project is. It might take 3 months, it might take 6 months, it might take 12 months. It depends on,
And during that time, you gotta pay.
interest. Yep. Money's not free.
I'm not free, that's the.
Okay. So yes, to I think you were asking about the ARV. So the ARV is what the appraisal is going to come and say, you bought this property, today it's worth 200. Based on these updates that you're going to do to the property, the property should be worth, let's say, 350 after it's all said and done.
So that's where you get your.
That's the ARV. After repair value will be 350, let's say. Yeah. Yeah, after repair value. Okay.
And as a realtor, if I find the investor, it's the same as finding somebody who wants to buy something.
Yeah, so as realtors, the benefit to you as realtors to doing these types of transactions is, number one, you're typically helping that client buy a house in the first place, so you're getting paid on the front end. Now you're only getting paid on the purchase price, right? So if the purchase is 200, that's what you're getting paid on. But the idea here is you want to keep the contact with that client because, number one, that client will probably buy another fix and flip later on the line. But if they are flipping it, then the idea is you have the conversation up front. Hey, I'm going to go ahead and represent you on the purchase. When you're ready to sell it, give me the opportunity to market it for you. So now you're getting the listing.
Okay.
Okay, so that's the idea with these clients. You want to make sure that you tackle the front end, but you're also trying to tackle the back end, you know,
Get paid twice,
right? Get paid twice, 3 times, 4 times, 5 times, because the person that does a fix and flip one time is going to do it a second time, a third time, a 10th time. So if you can help them out the first time around, you're going to be their girl, right? They're going to keep coming to you. And if you can keep finding them properties to buy, right? Now you've become an added value because now you're bringing them these properties to buy. And there's a reason why they're going to keep doing business with you.
Okay, and that number 2 one say it's higher than 100% rehab budget. So who providing that service? You.
Right. That's the lenders.
So look, she's my client and you know, she wanna do this, right? She found a place for 200,000 and she had the 10% to put down.
Right.
So that means that we already started the transaction, right?
No, you're going to go through the same process. We're going to
Okay,
go through a
so-
purchase contract. Right. You're going to go through a purchase contract. We're going to go through the financing period. So the question is, what's the process basically once you find and identify the property? So you're going to go through the same process. You're going to identify that property. Okay. You're going to go ahead and get them under contract.
Okay,
In their inspection period, you're going to go ahead and say, hey, we got to do our traditional inspection, but I'm also going to use this opportunity to have a GC come out and look at this property. So a lot of times the seller may not let you do an inspection, a traditional inspection, but they're going to let you come out with your GC because remember, there's going to be issues with the house. That's why you're buying it for $200,000. So you're going to go out there with your GC and your general contractor, and your general contractor is going to say, hey, you know, we got to redo the floors. We got a new roof. We need windows. We need to remodel this kitchen. And then you're going to go in and say, well, yeah, I want to remodel that kitchen. I want to remodel the bathroom, even though it's in good shape, but I want to update it. You know what? I want to knock this wall down. I want to make this into a 3-bedroom house instead of a 2-bedroom house. And the GC is going to say, great. To do all of this is going to cost you $100,000. That's their budget. They're going to give you an itemized budget. Okay. That's the budget that you're going to submit to us, the lender, to make sure that our construction team evaluates that,
okay,
make sure that it is in line. And then that's what we're going to submit also to the appraiser, so that when the appraiser does the inspection report, he's looking at the actual purchase price and then actually the updates that are going to be done and what that value should be at the end based on the market data.
okay, but and that's gonna be before everything is done.
That's part of the loan process,
Okay,
correct?
good.
Yeah. We won't approve the loan. We won't give final approval on the loan until we have the contractor's budget and the appraisal. Those are going to be the 2 things that this loan is going to, the biggest 2 things this loan is going to rely on. Yeah. Great question. For real. Thank you. Okay. You guys got that question, I hope. Marlene is very versed in this information, so she can also share with you guys, hopefully at some point in the future, a presentation or maybe a scenario in more depth on this. But I want you guys to know that if you run into this buyer that is an investor and that says, I want to buy a property, but I don't have the money to fix it, we have the options for them. Okay. Yeah. We have options for them. Okay. So this is great question and great information to know for you guys to be able to do your job a little bit, not better, because it's not that you're doing a bad job, but so you could be able to market better. Okay.
I have a question. So if they're not planning to use a general contractor, for like the whole project, they know, let's say I have people that are interested too, and they know plumbing, electrical and all that stuff, so permits by owners instead.
Right.
Do you need to still hire that general contractor during that loan, or can you just hire them just to give you the values and then move on?
So the question that we're getting is, if we have a person that basically has their own contacts, is going to do permit by owner, do they need to use a GC or can they do the work themselves and get paid? So it depends if they're experienced or not. If they're experienced at doing fix and flips, then they can do some of the work themselves. The catch is they can't get paid for the work they do themselves. They could get reimbursed for the cost of the materials, but not for the labor. Okay. Now, if they're the GC is just an initial quote. If instead of using a GC for the whole project, they decide to, they're going to get a plumbing company to come out and do the plumbing work themselves, They're gonna get an electrician to come out and do the electric work. They're gonna get their own AC guy. They're gonna get their own roofing. As long as all those individuals are licensed individuals, we can go ahead and submit an invoice and they can get reimbursed for that payment. Whatever work they do interior inside their house. Maybe the guy knows how to paint really well and he wants to paint. Great, he can paint the whole house himself. He can't get reimbursed for the labor of painting. He can get reimbursed for the paint and for the materials for painting as long as he provides receipts. Okay.
But that'll leave the loan lower anyway, so.
Yeah.
they'll Make the money eventually for the flip.
Sure. Yeah, if you can save money on labor and you can do it yourself, again, the lender is going to look at the experience of the individual. Okay, so if and Marlene and I are actually working on a scenario like this now with a client of hers where they have fix and flip experience. So yes, we'll allow him to get reimbursed for the materials of what he does, but you still want to have a licensed individual do the main stuff. You want to have a licensed individual do the roofing, windows and doors, plumbing, electrical, all of that kind of stuff. Leave that to a licensed individual.
Hold on, so is that covered in a rehab budget?
Yep.
But she was saying like, if we have somebody separate that we know, or is that?
Yeah, so you're gonna get a rehab budget always from a GC. And why from a GC? Because a GC is gonna tell you it costs 100. Maybe you get it done for 75. But would you rather have a loan for 100 and know that you can tap into it if you need to? Or would you rather be capped at 75? So the borrower is gonna want to say, give me the loan for 100. This is the best and highest quote I have. I want a line of credit for $100,000. Whatever you can save money on as you're doing the work yourself, you can go ahead and, again, if you have experience as an investor and as a fix and flipper, you can do some of the work yourself. But if you're not a licensed electrician, you're not a licensed plumber, you're not a licensed roofer, you're not a licensed, any of those kind of things, it's going to be much harder for you to do a roof and for the bank to pay you back if you're not a roofer, right? So you want to make sure that if you are doing work yourself, it's work that can be deemed as a handyman work, painting walls, putting up drywall, putting on baseboards, right? Those are, installing kitchen cabins. You don't need a license for that.
And does this, for somebody getting a fix and flip, does this, qualify as the first time home buyer?
No, we're only talking about investors.
No, that's what I'm trying to understand. So if I have a client that never bought a home before.
They're not going to get this loan.
Oh.
Yeah. In order for you to get this type of loan, you have to own your primary residence. Yeah. If not, they're not going to get this loan. So the question was, if this is their first time buying a home, can they use a first time buyer program? And no, the answer is no. This is not for first time buyers. This is for people that already own their home, their primary home, and are investing in real estate.
So if they just want to become an investor and haven't owned a home before, they have to go through something else?
Yes, there's FHA 203K programs that allow for them to be able to buy a house that needs repair, and they just qualify that through that as an FHA loan.
And they still can do the same process?
It's more complex. I'm not gonna go into that detail right now. We can do it as a one-off, but yeah, it's a much more complex process, but there is a possibility to do that for a first-time buyer. But that's an FHA loan and it's completely different. I don't want to confuse anybody today with that.
If they don't do FHA, is it mandatory you have to do FHA if you haven't got a first home?
If it's
If they don't have to do FHA, but they still have to put, like, what if they just want to put 20% down?
so if they're buying their first time home,
Yeah,
there's no loan options for them right now for fix and flip or for repair loans. They have to either go FHA or they have to go new construction with Fannie Mae.
okay.
No investor is gonna lend money to a first time buyer that's gonna try to do a fix and flip, a fixer upper. It's too much risk for them.
If it's a startup company that wants to go into flipping.
So the question is, what if it's a startup company that wants to go into flipping? Again, if it's their first time investing, but they own and everything else, and this is their first time investing. With one particular lender, we can do the fix and flip, even if they have zero experience. But same thing, they have to have all licensed individuals. They can't do any of the work themselves. Okay. And then after they do a couple flips, then we can lend to them and they can do some of their own work.
That's this one, but potentially they could get a private one or? No.
Without experience, no. Yeah, and if they do find, I mean, I'm sure there's lenders out there that would do private money for them. They're gonna be really, really high rates. Like private money rates right now are between 12 and 14%. If somebody has zero experience and a lender's gonna lend to them, they're probably gonna lend at 17 to 20%. Okay. So, and that was a great question that Gen Z asked, which is, if they don't have experience and they want to start doing fix and flip business, will a private money lender lend to them? And the answer is not really. Now, I always say there's a loan solution for everything. It's just realistically, how much are you willing to pay for it? So, can you find somebody that will lend to a first-time investor? Yeah, I'm sure you can. How much is it going to cost? And is your buyer willing to pay that money? Okay. Now, as I mentioned earlier, if it is a complete startup, this is their first time investing, but they can get a sponsor, which usually the private money investor will recommend a sponsor. Okay. Then they'll do the loan for them, but only if they're willing to work with a sponsor that will guide them through their first and second flip. So there is an option, but again, that's not costing you a higher interest rate, but it's costing you part of your profits, right? So there's a cost to it, right? All right. So just last slide is what's required to, second to last slide, what is required to apply? We're always going to need identification, which is either driver's license, passport, social security, resident alien card, work permit. Most of the time, we're going to need 2 months of bank statements just to show that they have the assets to do the investment and for money laundering purposes. Income documents as applicable. So if we're talking conventional loan, traditional stuff, pay stubs, bank statements, W-2s, tax returns, etc. If it's a bank statement loan, we're going to need 12 months of bank statements. It's a profit and loss statement. If it's, again, the debt service loan, we're going to need the income from the appraisal. So there's going to be income documents as needed, credit report, and then the investor status, which is what we've already talked about. Are they a first-time investor? Do they have experience? Have they done 2 to 3? Have they done 4 to 5? Have they done, more than 5 properties? Okay. These are the things we're going to ask for to apply. Whenever you do a loan through me, I have to take a full application. So that means that the client has to complete the URLA, the URLA, which is the application for mortgages. They need to complete it. They need to put in all the information, name, social security number, date of birth, address, living history, employment history, all of that kind of stuff. And we pull the credit report. Okay. Private investors, believe it or not, ask for credit reports because they want to make sure that who they're lending money to is somebody knows how to manage their finances. It's usually the principal owner. If they're all 25%, then a lot of times if it's 25% or over, a lot of times the lender may ask for all the owners that are 25% or more. Typically, if it's less than 25%, they don't ask for it. They don't, because if you have a company that has 30 individuals in it, they really don't care. They want the principal borrowers. But there are some companies that'll do it just based off of who's willing to sign that principal guarantee, that personal guarantee. Okay. The question was, if there's more than one owner of the company, do they all have to sign? So yeah, it depends. Okay. I hate to say it depends, but it depends. Now with a lot of these loans, again, the biggest thing to consider is mostly these loans are going to have what's called a personal guarantee. That means that I'm buying the property and I personally, Alex Pinacho, is going to guarantee this loan because I know I'm buying it. Okay. Even if I'm buying it under a business name, doesn't matter. At the end of the day, I'm the principal of that company. So if this loan fails, they can come back after me. Now, there are some private lenders that do no personal guarantee. You see that a lot more when it's an 8+ unit building. Okay. So that's where they may do a no personal guarantee. It requires a much larger down payment. Okay. And then this is definitely the final slide. Interest rate factors. People always ask me, what do the interest rate looks like? Well, it's based on the loan type. Okay, so we already addressed that. If it's conventional, if it's non-QM, if it's private money, right? So that's the biggest factor. And then the other factors that are going to take into account, and I try to put them in order from the most impact to the least impact, but that's not necessarily the case all the time. So credit score, loan to value, debt to income or debt service. Let me go back. Sorry. Credit score. The higher the credit score, typically the lower the interest rate. Loan to value. The lower the loan to value, the better the interest rate. If you're getting a 50% loan to value, your rate's going to be better than if you're getting a 90% loan to value. Debt to income or debt service. If the debt to income is lower, your rate's going to be better. If the debt service is higher, your rate is going to be better. Sorry, it's a lot of information, but I'm just trying to touch on this, okay? Your loan terms. A 30-year loan is going to cost more than a 15-year loan. A 15-year loan is going to cost more than a 5-year loan, okay? But obviously, that's when you talk about conventional loans. When you talk about private money loans, for example, a 1-year private loan is going to cost less than a 18-month private loan or a 24-month private loan, okay? The loan amount plays a factor in some cases. Some lenders will charge more if the loan amount is less than 150,000. They'll charge more if the loan amount is more than $1 million, let's say, or more than $2 million or more than $5 million. So they have thresholds where they may charge more or less. And again, all of this is determined based on risk. The property type, condos have higher interest rates than single families for obvious reasons. Condos are really difficult to sell. There's a lot of issues that are outside of the owner's control. So it's a higher interest rate. A duplex may have a slightly higher rate than a single family, at times. So just kind of things to keep in mind. That's not necessarily the case, but definitely the condo status, the townhome status, how old the property is. There's several factors to take into consideration on that rate. And then the investor status. That's the one I talked about several times. If you're a first-time investor, you're a higher risk. If you're an investor that's done 10 properties, you're lower risk. Okay? Gotta pay your dues. Gotta pay your dues. All right. And what I want to bring out to you guys is when I do these presentations, I'm not trying to turn you guys into mortgage people. I'm trying to help you guys learn what you need to know to be able to, how do you get a piece of the pie? How do you get in front of investors? What's the benefit of getting in front of investors? And I'll tell you that when you get in front of an investor, that investor is not going to buy one property. That investor is going to buy multiple properties. If you can establish a relationship with a first-time investor, okay, you can get a client that's going to have maybe only buy one more property, or you can get a client that's going to buy 10, 15, 20 properties over the next 15, 20 years, okay? So I want each of you to think about how old you are, how long you expect to be in this career, okay? And what happens if you find one client that's going to buy 20 houses over the next 20 years? How would that impact you? How would that impact your pocket? Okay? You hear me talk about relationship all the time. This is the first thing I say, and this is the last thing I always say. We are in a relationship business. If you're looking at clients as a one-time borrower and that's it, or a one-time buyer or one-time seller, you're missing out on a lot of opportunities. Okay? Investors love to keep buying. They buy when the market is up. They buy when the market is down. They fix and flip. They buy land. They buy multifamilies. They sell their properties. They do 1031 exchange. They buy another properties. This is what investors do. Okay? This is why this topic is so important, because now you guys know what I have in what you have in your pocket. If an investor says, I want to invest in properties, but I don't have a lot of money, well, great. We can help you with that. We can help you get there. Well, hey, I want to invest, but I can't buy a $500,000 home. No problem. I just found this property off market. It's $200,000. It's a property you're going to have to fix and flip. Let's get you connected with somebody that can help you maybe get in the fix and flip business. Okay? But this is the purpose of this conversation. It's not, again, I don't want you guys to think about how to underwrite a loan. I want you guys to think about what's available for my buyers out there. How can I tie in that relationship for the next 10, 15, 20 years? And not only continue to benefit from that relationship, but guess what? investors usually hang out with other investors. If you guys are amazing at what you do, and you have a partner like me that helps your buyer get the transaction done, they're not going to come to me next time. They're going to go to you next time. I don't want them to come to me. I want them to come to you. They're going to come back to you and say, I'm looking for another property. I have a friend that's looking for another property. I have a friend that wants to start a fix and flip business. Okay. How do we get them started? You guys are the point people here. Okay. So that's what you need to look at when you're looking at these types of clients. Is it's phenomenal to be able to help a first-time home buyer. I love helping first-time home buyers. Okay. Those are the clients that make me feel at night like I'm doing something good for everybody. But at the end of the day, we all got to put money on the food on the table, right? So if you can find clients that are going to invest and start building their portfolio, you can be that point person for them and for all of their family and friends. Okay. So again, relationships are key. You guys need to focus on building relationships. All right. If you haven't sat with Joel for a couple minutes, for a couple hours, you guys need to see how Joel does business. You know, see how he makes phone calls. Every time I come in here, he comes in here first thing in the morning. He starts getting his phone calls done. There's a reason why he's been in the industry for so long and he's making phone calls. Okay. It's relationships and it's the hustle and bustle. You never stop. So there's a lot of stuff out there. I'm here to help you guys. I'm usually here once a week. Sometimes on Wednesdays, sometimes on Fridays. You have my phone number, you have my email, you have my QR code, you have my website. I'm available. How many times have you called me and I've answered the phone when you call me? Anytime you call me, I answer the phone, right? Whenever we have a client, if you guys have a question you're not sure of, call me. I'd rather you call me than you don't call me. Just call me. If I can help you, more than happy to help you. All right. But I can only help you if you guys call me. All right. So I'm going to cut it off. We've been about an hour and 6 minutes. I got to figure out how to stop the Zoom presentation. But before I do, I got a few people on Zoom and I haven't seen any questions come in. Do you ladies have any questions for me? Melody, Karina, Regla, any questions? I'm going to take the silence as a no. Thank you very, very, very much for being here today. I really appreciate you guys. And I appreciate the opportunity. Please feel free to reach out whatever method, and I'm happy to help whenever I can. For those of you on Zoom, bye, have a wonderful day, and we'll see you soon.
Okay, hold on. Let's see here. You got all your folks connected. Y una foto. Filiberto, te quiere poner aquí en la foto. Joel, te quiere poner en la foto. No importa.
We need your pretty face over here, Joel.
Thanks, dear. And yeah, you could take it.
Wait, let me put the slideshow
Hi,
back.
Tony, good to see you. How are you? Haven't seen you in a while. Long time. How you
I
doing?
want to officially,
You good?
yeah, I want to officially welcome Joel Milian to Canvas Real Estate.
Yeah, how about that? I'm official. I told her I'm official now. I'm official.
Okay, put it on for the picture.
All right. Por supuesto. Especialmente ahora acabo de ir a mostrar propiedad y no tengo mi art logo, por lo menos tengo mi.
Sí. I was gonna tell you guys, Filiberto's listing came back on the market 2 minutes ago.
Okay.
158 East 16th Street, Hialeah.
Okay, I came back.
It came back and it appraised for 525,
Okay.
the asking price, okay? So if somebody has 158 East 16th Street in Hialeah, please. Okay, nice big smile. Perfect.
You want to take one like this so you get the background there?
Yes, you're right. You're right.
Let me put the canvas cup here.
Cool. Man, what you-
It wasn't supposed to do that.
There you go. Okay.
Awesome.
¿Cómo te sientes?
Mejor que ayer. Así es.
Ah, bien.
Ayer fue un día
Sí.
difícil. great. Ooh.
Guys, bagels, para que quiera bagels, for whoever wants bagels,
Coffee.
they're fat-free and sugar-free, all of them.
Yeah. With bagels.
There's another cream cheese in the fridge, but I don't think I grabbed the plain one.
You did at all?
No, I thought I did, but it's a honey almond one.
Ooh, that's my favorite.
But I meant to buy a plain one, and I guess I grabbed the wrong one.
It's okay. That's okay.
Yo siempre digo, mejoramos todos los días, porque
We are.
si no estamos mejorando, nadie quiere empeorar.
That's it. Sugar. Sugar, no sugar, no bread, no meats, no eggs. No,
You're doing plant-based?
no, it's called, Daniel Fast. Daniel Fast is everything as close to the seed as possible.